Then we have accounts receivables. After accounts receivables, we have inventory. And then we have some short-term investments which are made. Whatever are the funds which are available are invested into short-term investments which can be easily sold in the market. Okay, so short-term investments and borrowings. Once they understand that they have some amount of cash available, instead of keeping it in the form of cash, it is invested. As the name says, it is for a short period of time. Done. The intention behind that is, see, we've discussed that current assets and fixed assets as compared to that. The fixed assets, the return on fixed assets is more than the return on current assets. So, return from the fixed assets is higher. But the problem with fixed assets is it cannot be easily converted into cash. So, when as and when they require cash amounts, fixed assets do not come to their rescue. It cannot help them in liquidity. It is only the current assets which can help them in terms of liquidity. So for that reason, see, these additional funds, whatever are available, instead of investing in fixed assets, are invested in short-term investments. Like they can be easily sold in the stock market. They can be converted into cash, maybe investments by banks or financial institutions. They just go in for investing into these things, and then later on they can convert them back into cash as and when they require. So these are what are short-term investments. So these are used for temporary cash surpluses. So there is a cash surplus. So that is used for investing into these things. To weigh up an investment, a company has to weigh up three potentially conflicting objectives and the factors surrounding them. The first one, the liquidity. The second one is safety. The third one is profitability. In terms of liquidity, the cash must be available for use when needed, as surplus is only short term. So it will help in the liquidity part of it. The cash must be available. So these surpluses which are invested into, or rather, which are invested into the short term investments should come to their rescue, should be helpful as and when they require the funds. So it should help in liquidity aspects. The cash must be available for use when needed, as the surplus is only short term. So because it is a temporary availability, so as soon as the need arises, these should be in such a way that can be converted into cash and meet the required requirement. The second part of it is safety. Safety is, there is no risk of loss, no risk of loss, or the investment would not be lost. So maybe they have to compromise on the profitability part of it, but the security, the safety part of it, the investment would be safe. There would be no issue of losing their investment. No risk of loss must be taken, as once the surplus period is over, the investment must be converted back into cash to meet the business needs. So it is only with the focus that as and when there is a requirement, that requirement would be met with this investment which gets converted into cash. That is the whole purpose behind it. It is not with any other intention. So it should be easily converted into cash. Okay, and that should not put them in a risk. The risk should not be there. It is not on account of non-convertibility that they are not able to meet the payment. So they should be in a position that they are able to convert this investment into cash. So it should take care of the safety part of it. Their investment should be safely converted. There should be no risk of losing their investment amount. There should be safety in terms of converting it into cash, as well as the whole amount of investment, getting it back and using it for meeting the current liabilities. On the profitability note, okay, on the profitability note, because subject to the above, the aim is to earn the highest possible after tax returns, subject to the above. Considering these two facts, the priority is these two. It is not the topmost priority is not to maximize their profit. The priorities are liquidity and safety. They should be, no matter what is the situation, they should be able to get it back into cash. So liquidity is the priority. After liquidity comes the profitability. So subject to the above two, then they have to look into what best way they can make maximize their profit. But profit doesn't take the first place. Okay. First importance is given to liquidity, safety, and then comes the profitability. Short-term investments and borrowing solutions. Short-term borrowings. There are two main sources of bank lending. One is bank overdraft, another one is bank loans. See now, if they do not have these required amount of current assets, let's say current assets are not able to get converted into um, cash. First, we have looked into what are short-term investments here, short-term cash investments. Now we've discussed all of them, short-term cash investments. Coming to the current liabilities, so we have a set of current assets. All these current assets get converted into cash and a set of current liabilities. Now this should be used to repay the current liabilities. But say suppose the current assets are not sufficient enough to meet their liabilities and the other expenses. In such a case, what are the best ways of borrowing? Borrowing is a current liability. uh, the investment part of it is a current asset. Short term investment is a current asset. Short term borrowing is a current liability. So they can borrow it for a short period of time by way of a bank OD, bank overdraft. It is flexible and cheap as only used when needed. So it is flexible and cheap. So yesterday, I mean the previous class also we've discussed a question, two questions wherein whenever there was no cash availability, there is some deficit arising, the best way in which they can raise the short term investment, short term borrowing is by way of bank overdraft. So bank provides this facility to overdraw more than what is invested into the bank. That is the overdraft facility. It is flexible and cheap as only used when needed. So only whenever it is, that facility would be there with them, but it doesn't mean that they would be using all the time, as and when it requires. So for that specific period of time when they have used, only for that period they need to pay the interest calculated on bank overdraft. So it is easy, flexible, cheap, okay, but repayable on demand, may require security and interest rates can change. So this has to be repaid on demand whenever the bank wants it. It cannot be availed for a longer period of time. It can be availed only for a very short period of time, in days or at the most weeks. That's it, not beyond that. So it is not a facility which is available wherein they can avail it for a longer period of time. Okay, that short term gap, whatever is arising because current assets are not sufficient enough to meet their current liabilities, or cash is not sufficient enough to meet their current liabilities, only in such situations they avail this overdraft facility. Another way of raising current liabilities is by way of bank loans. So less flexible and more expensive as paying for a fixed period even if cash balances recover. So short term bank loans which are raised, they are less flexible and more expensive. So the current liabilities, we see that they are more expensive as paying for a fixed period. So even if they are repaying it within a short period of time, whatever is the specific period of time, for all that period the interest has to be paid, and it is a more secure way of raising the loan. Now coming to the working capital funding. Working capital funding. Work, how would they fund this working capital? Now we already discussed about what is working capital. Is there some problem? Only two students are there. Any event in the college or something like that?
For juniors for 2019 batch, the college has been started from today.
So they all would be.
Offline. Yes, ma'am.
Okay, okay, okay. Then you should have
Ma'am, but the timings have been managed. The timetable is made according to the classes which we are having with you and the university.
mm-hmm. Okay. I know these are all important topics now, so why are they missing? That is my point.
Ma'am, I'll put the message. Let's see
Yeah,
when this will.
maybe they'll join.
Yes, ma'am. Might be later. They might be joining.
And so we've already understand what is working capital, the excess of investment in current assets over the current liabilities. So now, how would they take up their working capital pattern? So we see that current assets are more than the current liabilities. So that point is clear. Current assets are more than the current liabilities. But from where will this investment come into current assets? The investment into current assets comes from the liabilities. So there are current assets, there are fixed assets. So these assets are invested from the liabilities which are raised from various liabilities. Liabilities are current liabilities. This is for short period of time. After that, we have a set of long-term liabilities, which are we call it as long-term liabilities from the outsiders plus the equity. So the time period, the time duration is long for long-term liabilities and current liabilities are short period of time. Because current assets are more, because they are more in amount, current liabilities alone are not sufficient to invest it into current assets. So let's say that if they are looking at a ratio of 2 is to 1, if their strategy is to invest current assets double the amount of current liability, so only one part of the current assets will be financed with current liabilities, but the rest of it has to go from the long term sources. Okay, so this is the way in which the balance of long term liabilities are invested into fixed assets. So that is how the strategy goes. That is the way in which they invest their raise their liabilities and invest it into various assets. So current assets are made up of two elements. First one is permanent and the second one is fluctuating. The portion of current assets that are effectively fixed. Example, buffer inventory levels, minimum receivables and minimum cash balance. These are not used for meeting their liabilities. So we see that there are certain amounts which are maintained all the time. At any given point of time, these are not converted into cash. There's something called a safety stock. All the time, this ensure that the stock is there in the stores or available for production. So that is a kind of a safety thing. Minimum receivables balance, maybe even if all the other receivables are converted, they ensure that a percentage of amount is there is in receivables, some amount of minimum cash balance. So they cannot be converted into cash. Okay, they are not converted into cash, so they are kind of dead, permanent current assets here. That portion of the current assets that are effectively fixed in nature, they are there under current assets, but very difficult that they can get converted into cash so that it can be used to repay the current liabilities. Second one, fluctuating, is those that get converted into cash. So um, amount is invested, then it gets converted into cash. So there's another type of current asset which is called as fluctuating. So the portion of current assets that changes, example, inventory above the buffer level, receivables and the minimum level, all the other current assets are easily converted into cash. Then the choice of funding working capital is either from short term sources or long term sources. So short-term sources, cheaper due to lower risk for investor, but more risky. Risk arises because the payment date arises much faster. So because of the payment date arising faster, they have to repay these short-term resources. But as compared to the long-term resources, short-term resources are cheaper form of resources. But the risk element is quite high because on the due date, cash should be available to pay them back. So the features, the attributes, features of current liabilities are they are cheaper, but they are riskier. Then long term sources, more expensive but than short term, but they are less risky because the due date doesn't arise in a short period of time. Long term liabilities, at least in a very long period of time it arises. Equity doesn't, there is no repayment period. As long as the company exists, it runs, the amount is there with the company only. So in terms of risk aspect, we see that the risk is less, but they are um, expensive, more expensive than short term. Now, what is the strategy which has to be adopted? There are three different strategies: aggressive, conservative, matching. Now, we are focusing both on the liquidity part of it and the profitability part of it. So, there are two aspects which have to be focused: one is liquidity, one is profitability. Aggressive, there are three different strategies of how the amounts are funded into working capital. The first one talks about aggressive, finance most current assets including permanent ones with short term. So all this short term is invested into current assets. So um, that's called as aggressive. Most of the investments into current assets are invested by current liabilities. So um, the point here, if that is taken up, they are very risky, the risk is quite high, um, but the profitability is also high. There is a relationship between risk and return. When the risk is high, return is also high. That is the relationship. When the risk is low, return is also low. Here we see that they are more profitable. Why is that they are more profitable? What is the attribute of short-term liabilities? Short-term liabilities, we see that they are cheaper. When they are cheaper, they become more profitable, but all of them are to be very quickly paid, so they are riskier. So these two aspects are there: cheaper is there, riskier is also there. So on account of cheaper form of resources, they become more profitable, but at the same time their risk increases. So risk is high, return is high in case of aggressive. Okay, the next one, conservative. Conservative is they do not raise much funds from the current liabilities, but the long term liabilities are invested into the current assets. So they are kind of safe in terms of liquidity aspect of it. So most of finance most current assets including a portion of fluctuating ones with long term finances. So long term finances, the attribute is they are more expensive, but the only benefit is they are not paid immediately. So some of the current assets are fluctuating. They get converted into cash quickly. See, even if they get converted into cash, that cash will not be used to repay the long-term liabilities. And the profitability aspect of it is more expensive. So when they are investing more expensive funds, their profitability gets affected. So conservative approach, they are safe. They don't have to take up the risk of repaying immediately, but the impact on profitability is also seen, that they are safer, but they are expensive and results in low profitability because of high expenses, expensive and low profitability. Finance most current assets including a portion of fluctuating ones with long term finance, safer but more expensive. Okay, next one, a matching principle. A matching concept about matching current assets finance with short-term resources. So here, what do they do is um, current liabilities have a maturity date. So as on the maturity date, they ensure that their investment into current assets also matches with the date of maturity. So that is matching. The strategy which they are adopting is based on whatever is the due date. So they invest in such a way that the current assets get converted as on this particular date, and the cash can be used to repay the current liabilities. So that's matching strategy. Fluctuating current assets are financed with short term sources. Permanent current assets are financed by long term sources. So they categorize now here into two categories. So the fluctuating part of it, so those that get converted into cash easily. So they are matched with the due date of the current level. So this is fluctuating. Then we also have seen that there are permanent current assets. So those permanent current assets are invested with long term liabilities. So generally it takes a very long period of time to get these current assets converted into cash, and current long term liabilities also, they do not the due date do not arise anytime in the near future. Therefore the permanent or the fixed current assets are invested with the long term liabilities, and those that are fluctuating in nature, the one which get converted into cash in a short period, these current assets are used to these current assets are invested with the funds raised from the current liabilities, and also they are used to repay those current liabilities. So that is a matching strategy. So the working capital part of it, we've looked into what are the various types of capital, various types of current assets. One is permanent in nature, which are there kept as a minimum balance, but very rarely they get converted into cash, or very long period of time which takes for them to be converted into cash. Okay. Then we see fluctuating is which gets converted into cash easily. Then sources, we see that there are long term sources and short term sources, current liabilities and long term liabilities. So how would they fund their amount into working capital? There are three strategies: aggressive, conservative, matching. Aggressive, finance most current assets with the current liabilities only. So the due date arises, and it is um, kind of risky because the due date arises and then they have to meet the current liabilities on the due date. The only reason attracts them is short term resources are cheaper in form, and then the profitability would be more. Risk is more and return is also more in case of aggressive. In case of conservative, we see that long term resources are used to invest into short term resources. Long term resources come at an expensive price, so expensive rates, but yet the risk part of it is is quite low. Risk is low, return is also low. Okay, because long term resources are expensive, profitability will be low. Then we see matching concept is uh, the permanent current assets are invested with long term liabilities, and the fluctuating resources are matched with current liabilities. So, to ensure that the current liabilities are met on the due date, because the fluctuating current assets are invested in such a way that matches the due date and the payment can be made. After this, I hope this is all clear. Um, After this, we will okay, some more students there. Let's look at the advantages, disadvantages kind of thing. Investment aggressive approach. Investment in current assets is kept minimal. Hold a lower level of inventory. Follow strict credit policy. Keep less cash balance, and lower level of funds are tied in working capital. Lower financial cost. In the long run, firm may stay behind competitors. So lower financial cost, but the firm may stay behind competitors. Why do you think so? Can you elaborate on that? Aggressive approach. What is aggressive approach? What is aggressive approach? Just now I have explained. What is aggressive? They are using current liabilities and investing into fixed, investing into current assets. The reason is the current liabilities are cheaper. To maximize their profitability, they are willing to take up the risk which is arising, which is there in this investment strategy, that is using current liabilities and investing into current assets. But current liabilities would not be sufficient to invest into all the current assets, so they take care of investing lower level of inventory. So that's one point. They hold lower level of inventory. They follow strict credit policies. Strict credit policies ensuring that the the customers pay on the due date and very less amount of credit period is extended, or some strategy with the credit policy is followed. So hold lower level of inventory, follow strict credit policy, and then keep less cash balance. So ensuring that these current liabilities would be met on the due date, all possible strategies are adopted to ensure that the cash is available to meet the current liabilities. So the benefit of it is the finance costs are low because current liabilities are a cheaper form of sources. So financial costs are low. In long run, firm may stay behind competitors. Firm may stay behind competitors because they are not following the credit policy in a relaxed manner. They are kind of strict. So customers want someone to provide them some credit facility, and then um, be little relaxed in terms of collecting the amount. If the company has a very strict, rigid credit policy, then the customers do not have that benefit of relaxing in terms of making the payment. So here we see that that will disinterest the customers. Customers may move to the competitors. One thing, fine. Then they do not have any safety inventory levels, lower level of inventory. So any demand which arises, they are not in a position to meet that unexpected additional demand which is arising, because they don't have the inventory to take up the production and cater to the requirements of the customers. In that case also, the customers uh, get attracted to the competitors. Once the demand is lost, it is very difficult to get it back. So in the long run, firm may stay behind competitors. As of now, the profitability looks quite attractive because current liabilities are cheaper. They are very quickly converting current assets and then meeting that. So they're cutting down on the cost so that the profitability is more. But that doesn't serve the purpose in the long run. So in the long run, stability is what matters, and having a big share of more customers or big share of market is also what matters. Market share should be high. That is how they can survive in the long run and make more amount of profit. So that's the disadvantage here. We see lower financial cost is, yes, it's an advantage, but that proves to be an advantage only in the short run. In the long run, they may lose to their competitors. Then, in case of conservative approach, what are the advantages and disadvantages? They keep high inventory. because they don't have to very quickly repay. That conservative approach is you funding the current assets with long term liabilities, so there is no need for them to repay it immediately. Therefore they invest in all minimum stock levels, or inventory is high. Inventory is not a quick asset. It's a current asset, but it's not a quick asset. It doesn't get converted into cash very quickly. So when it is not a quick asset, so then we see that they are comfortable in converting this into cash in a very long period of time also, because there is no urgency to repay the long term liability. So they keep inventory levels higher, follow liberal credit policy, because urgency is not there to repay the. So that facility is also extended to the customers. So customers are also given long credit periods, cash balance as high as to meet any current liabilities immediately. Okay. Then we see what are the advantages. Higher sales volume, um, increased demand due to liberal credit policy. Okay, higher sales volume, increased demand due to liberal credit policy, and increased goodwill among suppliers due to payment in short time, because they have cash availability. They can meet their suppliers on time. Disadvantages: long term liabilities are costlier, so high increased cost of capital, higher risk of bad debts, because more the longer the credit period, higher is the bad debt risk. So higher risk of bad debts, then shortage liquidity in the long run. So in the long run, they would have a problem there, because these long term liabilities should be used for investing into fixed assets. But in the long run, because they have already used it in the short run, they would not have sufficient funds to make the investment into the fixed assets in the long run. So these are the advantages and disadvantages of conservative approach. So the modern approach takes a balanced approach between both the aggressive approach and the conservative approach. So they work it out in a balanced manner, categorizing the current assets as fluctuating current assets and permanent current assets. Fluctuating are invested with the current liabilities. Permanent current assets are invested with the long term liabilities. So that's the moderate approach. Okay. Um, so that talks about the working capital funding. So we've looked into what is the working capital funding, financing working capital. So we see that the time frame and the assets, the short-term finances, there are fluctuating current assets, and then we see permanent current assets. So fluctuating current assets are resourced with short-term finances. Permanent current assets are used with long-term or short-term. That is depends on what is their approach. So either they can invest it in with the long term sources or short term sources, but definitely the non current assets, or which are also called as fixed assets, are invested with long term finance. So this is how the financing of the working capital is taken up. So with this topic, we um, finish with the working capital part of it. So the rest of the time, let's work out few questions from the examination kit, because we have sufficient time to cover the other topics also. So since we have just now finished the working capital concept, maybe we'll take a working out. I mean, we can spend on the rest of the time on working out these questions, and tomorrow we can start with macroeconomic policy, and go ahead with the other topics which are there. So I I am sure that we will be able to do all the topics and then comfortably do the content. I'll take you to the examination kit, and we'll work out the questions. Just give me one minute. Let's start this one. Working capital management. We've done 48, I think. 48, we finished doing this one. 48 is done. 49 is a small thing. 49 also we've done. 50 is there. We've finished 50. 51 is also done. 53. Please look into 53. A company has annual credit sales of 27 million and related cost of sales of 15 million. The company has the following targets for the next year. Trade receivables days are 50 days, inventory days are 60 days, trade payables days are 45 days. Assume there are 360 days in the year. So this is one assumption. I hope you know what is this 360 days in the year is. It is assumed that uniformly all the months have 30 days in each month. 30 into 12 months in a year is 360 days. So either this or if nothing is mentioned, you can go with 365 days. But if it is specifically given as 360 days, stick to only 360 days. Assume there are 360 days in the year. What is the net investment in working capital required for the next year? We'll work it out in the Excel sheet. Okay. Sorry, it took longer time for me to paste it. Okay. We see the question here, 53. We are asked to find out what is the net investment in working capital required for the next year. So, how do we calculate this one? What is the net? We do not know any item of either current assets or current liabilities. Only thing is we know that credit sales are given to us as 27 million and the related cost of sales is given as 15 million. Apart from that, we do not know the current assets and current liabilities. But here we understand that there are two items of current assets, that is receivables are there. Then we see that inventory is there. And then one item of current liabilities is there. But then these are not given in the form of these are not in the form of amounts. These are just given in the form of days. Can we convert them into amount? Is there any possible way that we can convert it into amount? Do you see that? Are you aware of how is it possible that we can convert this into amount? What is receivables, trade receivables day? Receivables days is equal to, according to the formula, it is 360 days, because in a year they are assuming only 360 days, divided by receivables turnover ratio. This happens to be 50 days. So receivables turnover ratio is equal to 360 by 50. So how much would that come up to? 360 by 50 is how much? 7.2. 7.2 times. But then that is equal to, again we see receivables turnover ratio is equal to the credit sales. I hope you are aware of these formulae. Credit sales divided by receivables. So now can you tell me what is receivables? Receivables is equal to, the figure is 27 million. 27 million divided by how many times? 7.2 times. 7.2. So which is equal to, so we see 3.75 million is receivables. Similar fashion, let's work out inventory days. Quickly, all of you work out 360 days divided by inventory, which is equal to 60 days. So we get inventory turnover ratio. Inventory turnover ratio.
6 time. ITR is 6.
Okay. ITR is equal to 6 times, which is equal to, the concept is cost of sales divided by inventory. The formula for this one is cost of sales that comes up to, cost of sales is 15 million already given. We need to find out what is inventory. So find out inventory. Inventory is equal to 15 million divided by 6. 15 million divided by 6, which is equal to 2.5 million. payables days is equal to 360 days divided by payables, which is equal to 45 days. So payables turnover ratio. So payables turnover ratio is equal to, we see 360 divided by 45. Let me first finish it and then I'll explain to you. We have cost of sales divided by payables. So we can find out what are payables. Payables is equal to 15 million divided by in your college level, whatever you've learned, there is one variation of payables turnover ratio, payables days, how they are calculated. I don't know whether you've come across that, but there is also one formula of a payments turnover ratio is equal to, it is not cost of sales, but it is credit purchases. You must have come across, or even if you come across when you were going through the books, mostly in the Indian author textbooks, very precisely they give that. But here in this case, um, it is not considered most of the times, or in this particular situation it is not possible to find out. So that is another reason it is not possible for us to find out what is credit purchases. The formula for cost of goods sold, cost of sales, what's the formula for cost of sales? Anyone knows? Is equal to opening stock plus purchases minus closing stock. This is the formula. So if at all, if we have this information about what is opening stock and closing stock, here the inventory, the stock of 2.5 million is only the closing stock. We have no information about what is the opening stock. Because of lack of information that we are unable to find out purchases, we are not substituting here as purchases divided by payables. But technically the right way of doing this is, it should be purchases divided by payables. So that is how we are supposed to do, but we are not using that formula. The reason for that one is because some information is missing. But whenever we solve it in the Indian context, and we've been doing that over period of time, that we come down very specifically to the point that it is credit purchases and then substitute it. So if at all, if you have done something in the college level like that, here we need to understand it is not possible for us, because in this question there is no other additional information about what is the opening stock. So opening and closing stock, both of them are only when they are available, it becomes possible for us to find out what is purchases. Since there is information is missing, we are going ahead with substituting what is cost of sales and calculating. So now find out what is working capital. I think this part of it is easy. Working capital is equal to, we have the current assets and the current liabilities. Current assets, two items, receivables and inventory. So 3.75 million plus the 2.5 million minus 1.875 million. So how much is that? So option B is the right answer. Check that option B is the right answer. We've not worked out on question number 54. The next one, let's a cash budget was drawn up as follows. We have receipts and payments due October, November, December. Credit sales, cash sales, payments are also given. The opening cash is given. What is the closing cash balance for December budgeted to be? So let's put this one in the Excel sheet and then work it out. For how many months are we asked to prepare? We are asked to, we are just asked to prepare what is the cash balance at the end of December. So when we prepare the budget, see, here we see the receipts, we see the payments, and then there is one more thing which is called as the opening cash. So receipts, the total, you can find out what are the total receipts for the October, November and December. So receipts and similarly the payments. So receipts minus payments talks about, if receipts are more, we call it as surplus. If payments are more, we call it as deficit. Plus the available balance plus the opening cash. So when you add this opening cash, then you identify what is the closing balance. So closing balance here, the next step is we get to know what is closing cash balance. So here, whatever is the closing cash balance, this will go to the next month as opening balance. So verifying everything, then we find out what is the uh, November month closing. So this will again go to the December opening balance. Then we find out. So we can not straight away start with the December month and then find out what is the closing cash balance of December, because to find out closing cash balance, we need to know what is the opening cash balance of December. Once the opening cash balance is available, so for that we need to know what is November's closing cash balance. November, we need to find out what is the October closing cash balance. So because it is interlinked, what we do is we take all 3 months, October, um, there are two receipts on account of cash sales made, on account of credit sales made. Maybe in the previous periods they were made, and we have some collections receipts. Some amounts are received, so we can straight away add them up and then write it as total receipts. So total receipts would be 30,000 here, then 15,500 here, then we have 20,500. Then similarly, we also write what is total payments. So add them up. Is it 2,600? Am I right or wrong? Just tell me. 4262657.
Yes, ma'am. 26.
8,250. Then 10, 11, 12,700, I think. Um, we'll put it as some alphabets, and then let's take total receipts to be as A. Total receipts to be as B. So net cash flows would be A minus B. Apart from the current period receipts and payments, we also have the opening cash balance. Opening cash balance, which is 500. So once the opening balance is added, we see what is closing balance. So how do we get what is closing cash balances? To the available cash balance, the opening cash balance is added. So 9,900 is the closing cash balance for the month of October. So that goes to the next month, November, as opening cash balance. So this would be 9,900.
It's 17150.
Okay. Okay. So 24,950. 24, there are answers in the options overdraft and deposits. So overdraft is if the availability is less, that is it is in a negative figure. If it is there, we then they have to raise some amount, it would be overdraft. Otherwise, if it is a positive, it is deposit. So they have available cash balance by the end of December as 24,950. So that's the answer. 24,950 is the answer. Let's look at the 63rd question. The rest of them are all theoretical MCQs. You can answer them. 63rd question is given here. Crack company has sales of 200 million per year and the gross profit margin is 40%. Finished goods inventory days vary throughout the year within the following range. Maximum is 120, minimum is 90 for inventory. All purchases and sales are made on a cash basis and no inventory of raw materials or work in progress is carried. Crack company intends to finance permanent current assets with equity and fluctuating current assets with its overdraft. In relation to finished goods inventory and assuming a 360-day year, how much finance will be needed from the overdraft? So let me put this one on the Excel sheet and then we'll work it out. The sales are 200 million per year. Gross profit margin is 40%. So what is cost of goods sold? Sales are 200 million. Gross profit margin is 40%. So how much would be cost of goods sold? Then finished goods inventory days vary throughout the year. So the maximum inventory what is needed is 120 days. Minimum inventory what is needed is 90 days. So 90 days is the minimum and the maximum is 120. So these are the inventory levels which are maintained. Now here in this case, the difference between 120 days and 30 days is um, how much 120 120 minus 90. These are the inventory days periods. All purchases and sales are made on a cash basis and no inventory of raw material or work in progress is carried. Craig company intends to finance permanent current assets with equity and fluctuating current assets with its overdraft. Do we see any permanent current asset here? Is there any concept of a permanent asset? We've discussed that the minimum inventory levels, minimum receivables, and minimum cash balance are all permanent in nature. They hardly get converted into cash. So they are called as permanent current assets. They don't get converted into cash. Over and above this, so for 90, whatever is the stock requirement for 90 days, because at any given point of time, they want to maintain 90 days away, 90 days requirement of inventory as the minimum inventory level. So minimum inventory level is given to us as 90. So the minimum level is that they are maintaining. So that is the permanent current assets amount. Permanent current assets is the inventory requirement for 90 days. I hope you understood the concept. At any given point of time, they want to maintain that inventory level. Safety stock, what we call it as minimum inventory level is 90. maximum how much do they require for 120 days. So the difference between 120 and 90 is 30 days inventory. That 30 days inventory is fluctuating current assets. I hope I'm clear. Did you understand what is permanent current assets? Permanent current assets is the minimum inventory level which they want to maintain at any given point of time. So that hardly gets converted into cash. So that part of it is the fixed or permanent current assets. Over and above this 90 days, so that over and above that is going up until 120 days. So that 30, the difference between 120 and 90 is 30 days. The 30 days inventory level is fluctuating in nature. So fluctuating current assets is 30 days inventory level. So here it says that permanent will be financed with equity, fluctuating current assets will be financed with overdraft. The question is how much finance will be needed from the overdraft. So what is required? The requirement with the overdraft to be invested into working capital is 30 days inventory. So first thing is, let's find out what is cost of goods sold. Sales is 200 million. Cost of goods sold is the it takes care of the inventory part of it. So cost of goods sold will be, if gross profit margin is 40%, cost of goods sold will be 60%. You know that concept, no? Sales minus cost of gross profit is cost of goods sold. So we get cost of goods sold to be as 60%. I'll put it here for your for your reference sake. So 100% minus 40%, which is equal to 60%. Done. So cost of goods sold is 60%. So out of 200, it would be 200 into 60%. After that, our cost of goods sold is 120. Then after that, we understood what is the permanent current assets. Permanent current assets is equal to 90 days inventory. Fluctuating is equal to 120 minus 90 days inventory, which is equal to 30 days inventory. In a year, how many days are there is mentioned? In a year, they are mentioning that there are 360 days in a year. So let's find out what is the capital requirement or finance needed from the overdraft. Finance needed from the overdraft is equal to, we see 120. 120 is the requirement into, they want it for 30 days inventory, 30 days out of a year consisting of 360 days. So
Ma'am, 10.
10, okay, so is equal to, okay, 10 million. Done. So here the answer would be 10 million. 10 million is needed to be financed from the overdraft facility. Overdraft investment, the amounts which are raised from the overdraft will go into fluctuating current assets. So fluctuating current assets is 30 days inventory. 30 days in a year of 360 days. So the total finance needed is 160 into the fluctuating current assets. Now, let's go to another question. Max company is a large multinational company which expects to have 10 million cash deficit in 1 month's time. The deficit is expected to last no more than 2 months. Max company wishes to resolve its short-term liquidity problem by issuing an appropriate instrument on the money market. Which of the following instruments should Max company issue?
Ma'am, commercial paper.
Why? Um, I think we need to understand these aspects of. I'll put it on hold for this one, this particular question. You have given me the answer. Okay, fine. Interest rate futures. What are interest rate? I do not know whether you are aware of all these things. Corporate loan notes, treasury bills, commercial papers. So there are features associated with this. So now the commercial paper is a short-term um, source from which the amounts can be raised. Interest rate futures and corporate loan notes are for long term. Treasury bills are issued by VC on behalf of the government. These things are issued. So here in this case, the most suitable one goes with the commercial paper. There are other attributes and the characteristics which need to be looked into. But right now, it is not the time for us to discuss about that because we still have to learn about the money market. At that time, it would be the right thing. So as of now, go with the answer that the answer is commercial paper, but I think after a while, after we look into the money market instruments and all, we will be able to better understand and answer this one. Answer is, we have it as A, commercial paper. So put this one on hold. um, we will work out question number 60. Mile company is looking to change its working capital policy to match the rest of the industry. The following results are expected from for the coming year. We see revenues, cost of sales, gross profit. Revenue and cost of sales can be assumed to be spread evenly throughout the year. Then the working capital ratios of Mile company compared with the industry are as follows. Receivables days, inventory days, payables days. Year has 365 days in each year. If my company matches its working capital cycle with the industry, what will be the decrease in its net working capital? If it is matching with its working capital cycle with the industry, what will be the decrease in its net working capital? Now, this is what is given. So here it says that what will be the decrease? Decrease, they are very specifically stating that what will be the decrease in the net working capital um, when it is compared with the industry and on comparison with the industry. So how do we proceed further? Any idea about how do we have to work out? See, for all these three parameters, we see instead of writing difference, let's write reduced days, because um, all of them are reducing when we compare from this is 50 for mile company, industry it is 42, inventory it is 45, and industry it is 35, payables it is 40 for the company, and then industry it is 35. So reduced days is what we will write it here. So here it is 8, then
Ma'am, 8, 10, and 5.
8, 10, and 5. Done. Um, ha, we also have what is the sales figures and the other details are given to us. So the number of days reduced in case of receivables 8 days. So for that 8 days, what is the amount converted into receivables is what we will find out. Similarly, for the reduced inventory, what is the amount of inventory, and the reduced pay will also find out what is the amount of inventory. So that is how let's find it out, and then see the concept of working capital is the same, current assets minus current liabilities. So um, the I am not repeating the formula. So since we've done one question thoroughly about the days, receivables days is equal to, in a year there are 365 for this particular question, divided by, so we can find out. So the reduced number of days are 8 days. So proportionately for 8 days, how much would be, that is what we have to calculate.
I'm
So
45.6 means 46 days approximately for the receivable days.
no, we are directly proportionately calculating it for 8 days. So
Okay, ma'am. Okay, ma'am.
because the days already we got the days as 8, the reduced days are 8. So for taking that at 8 days, how much is the amount of receivables? Um, so find out proportionately for a year. A year has 365 days. The receivables go with sales, isn't it? So for a year with 365 days, we have the sales amount to be as 20,500 for 8 days, because specifically we've come down to that 8. So for 8 days, how much is the amount? So that's the logic with which we calculate. 8 days, what is the amount? So 8 into 20,500 divided by 365. So receivables is equal to, the next one is inventory. To find out inventory, also we use the same logic. Inventory reduced days are 10, 10 out of 365. applicable at cost of sales, which is 12,800. Then comes the payables. The reduced days are 5 out of 365 days, into here again we have it as 12,800. So can you find out how much is the according to, there are two current assets and then one current liability. So working capital, decrease in working capital is equal to, so we have it as current assets minus the current liabilities. So do we have 624? Mhm. Rounding it up is there. The right answer is, maybe we have to round it off to the nearest 100.
Ma'am, we will take A option as our answer.
A option only is right. But I am searching in the question. Sometimes they give it as round it off to the nearest thousand, the nearest 100. The closest one,
Okay, ma'am.
I was looking, searching for that, whether they have mentioned. Even if they have not mentioned, because we've come close to 624, 600. It is, if we round it off, it becomes 624, 600. Okay.
Yes, ma'am.
Answer A is the right option. So question number 68, 69, we'll work it out. Swap companies due to receive goods costing 2,500. The terms of trade state that payment must be received within 3 months. However, a discount of 1.5% will be given for payment within 1 month. Which of the following is the annual percentage cost of ignoring the discount and paying within 3 months? So, so please make a note of the formula. The formula says annual cost of discount is equal to, in bracket, 1 plus discount divided by amount left to pay, whole to the power of number of periods, the entire fraction minus 1. So this is a formula. 1 plus, uh, in the bracket, 1 plus, there is a fraction which is discount divided by amount left to pay, the whole thing to the power of number of periods. So the number of periods the number of periods, then minus 1. How do we calculate number of periods? Either we take all the years in a day, 365 days, or 52 weeks in a year, or 12 months in a year, divided by the number of days of discount, or number of weeks of discount, or number of months of discount. Earlier, the amount, the money is received. So for foregoing how many days of discount period did they avail this discount, that part we have to write it here in the denominator. So along with solving the question, we'll look into the solution, how to answer this one. So the terms are, the goods worth 2500 was sold. The terms of trade state that the payment must be received within 3 months. So the total credit period which is extended to the customers is as 3 months. However, a discount of 1.5%. So the cash discount which is given is 1.5% will be given if the payment within 1 month is made. So by foregoing the period of 2 months. So together, altogether they have to, they can avail a discount of 3 months period, credit period. But if they make the payment within 1 month, so which means that they are foregoing the benefit of uh, utilizing another 2 months credit period. So by foregoing that credit period, they can get a benefit of a discount of 1.5%. So that is the discount percentage. So by substituting this in the formula, let's work out um, what is the annual percentage cost of ignoring the discount and paying the paying within 3 months. So if cash discount is 1.5%, how much would they be paying? They would pay the rest of it, which is 98.5% is what they will pay. So how much amount will be paid? The total due amount is 2,500. Out of 2,500, excluding this 1.5%, the rest of it would be paid. So amount to be paid excluding the discount percentage, availing the discount percentage would be, so they will pay 2,500 into 98.5%.
Ma'am, the answer is 2462.5.
Okay, 2462.5. So this is what they would be paying. Um, Total credit period is 3 months. Total credit period is 3 months, but they can avail it when they pay within 1 month. Let's look at the formula once again. Please make a note of the formula. It's 1 plus discount. Discount amount divided by amount left to pay. So how much would they have to pay? The whole thing to the power of number of periods. So let's look at what is the number of periods. How many periods? The terms of the terms are the number of periods. Let's find out what is number of periods. In a year, number of periods in a year, because it's everything presented in a year. There are 12 months because it's presented in months. 12 months divided by how many months of credit period are they foregoing? How many periods are they foregoing? They're foregoing 2 months credit period. 3 months is the total period offered, but they are foregoing 2 months credit period. So 12 divided by 2 gives us 6 periods. So we have the to the power of number of credit periods is there. Um,
Ma'am, can you please share your Excel sheet again?
okay. All the while it was only PPT which was there. Okay,
Yes, ma'am.
I'm really sorry. So total credit period is 3 months. Discount can be availed if paid within 1 month, and the credit period foregone is 2 months. So the number of periods is 12 months divided by 2 months, which is equal to 6 periods. So the number of credit periods are 6 periods. One plus, there is a fraction given. What is that fraction? In the fraction, the numerator has the discount, the denominator has amount left to pay. The discount and the amount left to pay. So if this is what they are paying, what is the discount which they have availed? So discount would be 2,500 into 1.5%, which is equal to
37.5.
37.5. So here in this case, we have 37.5 divided by the amount which they have to pay, 2,462.5. So close the bracket. The entire thing exponential. We have 6 periods. from the total fraction minus 1. Maybe you can simplify this as 37.5 plus divided by 2462.5 beforehand, and then present it there. So that is a better way of doing it as 2462.5 to the exponential 6 minus 1. If it is converted into percentage, 9.49. Yeah. So the formula annual cost of discount is equal to 9.49 percentage. So that's the option D. Option D is the right answer, 9.49%. Quickly, let's do 69th question and wind up this class today. Um, will company incurs cost of $65 every time it places an order with its raw material supplier? It orders 300,000 units of product each year. The cost of holding 1 unit of inventory for a month is 2.50. Will company keeps a buffer inventory at all times of 25,000 units of material? Calculate the economic order quantity that will optimize the business inventory cost to the nearest 10 units. That's question number 69. So the formula for economic order quantity, the formula for economic order quantity is 2COD. CO is cost per order, D is the annual demand. CH is cost of holding 1 unit for 1 year. 1 year is the parameter there. Okay, let's get back to the question. Um, what's the annual demand? It orders 300,000 units of product each year. So annual demand, we see um, square root of the um, numerator has 2 CO order cost into demand. Okay, the entire thing divided by CH, that is the inventory cost per annum. Okay, whatever are the terms, the terminology, whatever is it, doesn't matter. CO is equal to ordering cost is, it says it is 65 every time an order is placed. After that, the annual demand D is equal to DC 300,000 units is what is needed. After that, CH for an year. The CH part of it is given as 2.50 per month. So per annum, calculate CH, which is equal to 2.5 into 12. So that is CH. Just substitute that and then find out what is EOQ. Got it as 1140 units.
Yes, ma'am. Same answer. I got the same answer.
Done. Okay. Any doubts in what we've done in today's class?
No, ma'am. Ma'am, can you please share today's recording?
Yes, yes, I will share that. Yes.
Ma'am, may I put my mail in the chat box?
Okay. Are you not getting the recording?
Ma'am, I'm getting, but the students are busy, so that's why.
So when I'm sharing to them, along with that, I will add your mail ID also. Please put that.
Okay, ma'am.
Yes.
Okay, ma'am.
Anyone else wants to receive it immediately along with the first time when I'm sending? Please write it here and then I will send it. I will post it to all of. Only three are there at the end. Okay. Okay. Simran question.
Yes,
Yeah.
ma'am. I put my mail
Yeah.
in the chat
Anyone
box.
else, if you want, you can also write it.
And students, I've told to inform you that today, for 2019 batch, that their college has been started from today. So that's why some of the students were not able to attend the class.
So speak to your coordinator, no? So maybe some arrangement will be made.
Okay, ma'am. Might be they might be joining today. That's why.
Okay. But
Yes,
from
ma'am.
tomorrow, then what will they do?
Yes, ma'am. They will attend the class.
Okay.
I'll
Okay. Okay. Please inform them. Tomorrow regularly at the regular time we'll meet. I will
okay,
take this mail ID and then
okay, ma'am. Thank you, ma'am.
okay. Okay, dear. Okay. Good day.
Good day to you, ma'am.
You may leave the class. Okay. I'm copying it.
Okay, ma'am.
You may
Okay, ma'am.
leave the class.